Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, what is the difference between solo 401k sole proprietor and an S-Corp? So this is your chance to get answers. Go ahead and use the chat to ask questions on today's topic or any other topics surrounding solo 401k plans, as well as self-directed IRAs. Please type them over so that we can be sure to get to them all. Let's get started. So what is the difference between a solo 401k for a sole proprietor versus an S corporation? For self-employed individuals, a solo 401k, also known as a one participant 401k, is one of the most powerful retirement tools available. It allows business owners with no full-time employees other than a spouse to contribute to retirement as both the employee and the employer, significantly increasing annual savings potential. However, the way contributions are calculated and taxed can vary depending on how the business is structured. Two of the most common structures are sole proprietorship, so think of a Schedule C, and then S corporation. Think of a Form 1120-S, which is the tax return that applies to an S corporation. Understanding the differences between these structures is important because the amount of income needed to maximize solo 401k contributions and the tax treatment of those contributions can vary significantly. So we're going to explain the key differences and how contributions work for each. Let's look at it from a sole proprietorship lens first. For sole proprietors, contributions are based on net earnings from self-employment. The general calculation is going to be, first determine your Schedule C, specifically line 31 figure. Once you know that figure, you then subtract 1/2 of self-employment income tax from line 31. Our online solo 401k contribution calculator will calculate the contribution for you once you type in line 31 of that Schedule C. Once you plug that figure in and the calculator reduces that amount by 1/2 of self-employment income tax, then for tax year 2026, for example, you're going to be able to make employee contributions to the solo 401k, as well as employer contributions. You can also make what's referred to as voluntary after-tax solo 401k contributions as well. With respect to the dollar amounts that you can contribute for tax year 2026, you're going to be able to contribute $24,500 as an employee contribution. That employee contribution can be applied as a pre-tax solo 401k contribution or as an employee Roth solo 401k contribution. Now, if you're age 50 or older in 2026, You can also make an additional catch-up amount of $8,000. And then there's the super catch-up amount, which applies to those who are ages 60 through 63. Instead of contributing $8,000 for that age group there, you can contribute $11,250. Obviously, you can't make both the normal catch-up and the super catch-up. For a sole proprietorship, these catch-up contributions can be applied as pre-tax employee contributions or as Roth solo 401k employee contributions. With respect to employer contributions, the employer contribution for a sole proprietor is up to 20% of that net earnings from self-employment income. So line 31 of the Schedule C minus 1/2 of self-employment income tax. You multiply that figure by 20%, and that is the amount of employer profit sharing contributions that can be made to the solo 401k plan. So because the calculation is based on self-employment income after adjustments, it often takes more income to reach the maximum solo 401k contribution limit compared with an S-Corp structure. So that's one of the differences between the S corporation self-employment structure and the sole proprietorship self-employment structure. It has to do with the fact that it takes less earned income from self-employment activity to maximize your annual solo 401k annual contributions if your business is taxed as an S-Corp versus as sole proprietorship. Now let's talk about the S corporations. So as an S corporation that sponsors the solo 401k, owners who work in the S corporations must receive W-2 wages in order to make contributions to the solo 401k plan. Because the contributions to the plan will be calculated based on your box 1 W-2 wages, the gross wages. So how are contributions calculated for a self-employed S corporation? The contributions are based on W-2 wages, as I mentioned earlier, box 1, that's the starting figure. And again, for 2026, you can contribute $24,500 as an employee contribution. So if you pay yourself, let's say, $24,500 of W-2 wages from your S corporation for 2026, you can contribute that entire $24,500 as an employee pre-tax solo 401k contribution, or you can choose to make it as a employee Roth solo 401k contribution. So if you solely pay yourself $24,500 of W-2 wages, then you're not going to be able to contribute any more than that. So in order to contribute up to the overall limit, which is $72,000 for tax year 2026, you're going to have to pay yourself more than $24,500 in W-2 wages from that S corporation. And you could also make a catch-up contribution of $8,000 if you're age 50 or older for 2026. But you're going to need to pay yourself, instead of paying yourself $24,500, you would now have to pay yourself $32,500 if you're going to make the $8,000 catch-up contribution. So bottom line is that employee contributions are a dollar for dollar calculation based on your W-2 box 1 gross wages. Now that we're going to talk about how the catch-up contribution or even the super catch-up contribution for those age 60 through 63 may have to be applied as a Roth solo 401k employee contribution stemming from the Secure Act 2.0 regulations surrounding having to make normal catch-up and super catch-up contributions as Roth solo 401k employee contributions and no longer as pre-tax solo 401k contributions. And that is unique to an S corporation. And we're going to talk about this more here in a little bit. It doesn't apply to a sole proprietorship, but it does apply to an S corporation, and it all depends on what your wages are as to whether or not you're going to have to make that normal catch-up or super catch-up contribution as a Roth solo 401k employee contribution versus a pre-tax solo 401k employee contribution. Again, we're going to cover that more in a little bit here. Give me a moment here while I get to my next slide here. Okay, so if you have any questions regarding today's topic or any other aspects surrounding solo 401k or self-directed IRAs, again, go ahead and type them over and we'll pause and answer those questions as they come in. For now, we'll continue with our with today's webinar presentation. Now we're talking about the various contribution types for an S corporation self-employed business. We just went over the employee contribution rules and the figures. Now let's talk about employer, also known as profit sharing, solo 401k contribution. So for an S corporation self-employed business, the employer profit sharing contribution is calculated on a percentage basis. So it's not a dollar for dollar calculation like employee contributions are, but rather a percentage. And that percentage is up to 25% of your W-2 wages. So because employer contributions are based on W-2 wages rather than adjusted self-employment income, less earned income is generally required to maximize solo 401k contributions compared with the sole proprietorship. For example, if you pay yourself $100,000 of W-2 wages from your S-Corp self-employed business, for example, for tax year 2026, you can contribute 25% of $100,000 as an employer profit sharing contribution, so $25,000. Contrast that with the sole proprietorship self-employed business, where you pay yourself $100,000 of line 31 Schedule C self-employment income. Well, you then have to subtract 1/2 of self-employment income tax from that $100,000 figure. And then the difference, you have to multiply by 20%. So as a result, it takes more self-employment income if your self-employed business is taxed as a sole proprietorship versus an S corporation to maximize your solo 401k contributions, both employee and employer. But that's especially the case with employer contributions. Now let's talk about employer Roth solo 401k contributions. So under provisions expanded by Secure Act 2.0, solo 401k plans allow for employer contributions to be designated as Roth solo 401k contributions. So this creates a unique tax situation. And here's how. When an S corporation makes employer Roth solo 401k contributions, the contribution is deductible on the S corporation tax return. So the Form 1120S. So just like the S corporation gets a deduction for making employer pre-tax solo 401k contributions. Same is true if it's made as an employer Roth solo 401k contribution. So it reduces the S corporation's taxable business income. So this can result in payroll tax savings and overall tax efficiency at the corporate level. Now, don't get too excited quite yet, because it's going to be taxed at the participant level. So even though the corporation makes that as an employer Roth solo 401k contribution, it's going to be taxable on your personal tax return, because employer Roth solo 401k contributions are treated as a taxable end plan Roth conversion. So what does this mean? This means the contribution is taxable on the taxpayer's, aka the participant's, personal tax return. And a Form 1099-R must be issued to report that taxable in-plan conversion of those employer Roth solo 401k contributions. So you're going to have to pay income taxes on the personal side. So it's not a free lunch. Some individuals mistakenly think that by making employer Roth solo 401k contributions, they're not going to have to pay taxes on that income in the year of the contribution. Well, it's true that the corporation gets a tax deduction for it, but on the flip side, now you're going to have to pay taxes on the personal side. So although the participant pays tax on the conversion, the funds, of course, are going to grow tax-free inside the Roth solo 401k. So you would actually make that employer Roth solo 401k contribution directly to the Roth solo 401k holding account, the designated account specifically used to hold those Roth solo 401k contributions. But then you're going to have to pay taxes on that contribution amount on the personal side. So you need to make sure that if you're a client of my solo 401k financial, that you complete our online pre-tax solo 401k conversion form, so that we collect the necessary information to issue that Form 1099-R to report that employer Roth solo 401k contribution as a taxable end plan conversion. Now let's talk a little bit more about why an S-Corp often allows higher contributions with less income. So in many situations, an S-Corp can be more efficient for maximizing solo 401k contributions versus a partnership or sole proprietorship business. And here are some key reasons. Employer contributions are going to be based on W-2 wages. No self-employment tax applies to those contributions. Employer contributions are not subject to FICA. As a result, it often takes less earned income to reach the maximum annual solo 401k contribution limit when using an S-Corp compared with the sole proprietorship. And we touched on this more earlier. Now, let's talk about the exception of where a sole proprietorship may be better than an S corporation self-employed business. And that has to do with the new mandatory Roth catch-up contribution regulations stemming from Secure Act 2.0. Give me a moment here. So one important change introduced by Secure Act 2.0 is the rule requiring mandatory Roth catch-up contributions for high income earners. Let me pull up some information on that. Give me a moment here. Okay, so beginning in 2026, if an employee earns more than the IRS threshold in wages indexed annually, then catch-up contributions, whether a normal catch-up or a super catch-up contribution, must be made as a Roth contribution rather than pre-tax. Now, this is unique to C corporations and S corporations, and this new rule does not apply to sole proprietorship or partnership self-employed businesses. So this is how this applies to S corporations. Because S Corp owners receive W-2 wages, this rule can apply to them. For those who are impacted, the catch-up contribution must be made as a Roth solo 401k catch-up contribution. They cannot be made as pre-tax contributions, in other words. And then taxes must be paid on that catch-up amount because obviously you do not get a tax deduction for that contribution because it's going in as a Roth solo 401k catch-up contribution. Let me see if I have some more information on this for you. Now, this is going to apply, this mandatory catch-up contribution will apply to an S-Corp or C corporation self-employed business, depending on what your Social Security wages are for the year. Now, Social Security wages are reported in box 3 of your Form W-2, which is the wage and tax statement. So if you have